A wall of analysts is telling you Micron is about to crash 75% in the next 12 months. Not a normal pullback, a full-blown collapse down to $250 a share. But here's the question none of them are asking. What if they're making the exact same mistake that made investors miss one of the biggest rallies in stock market history? I'm Alex Carter. Welcome back to Wealth Signal. Quick note before we dive in. Everything here is for education only, not financial advice, so always do your own research. Micron just closed Friday at $921, down about 7% after hours, and this morning it's slipping further to around $911. A whole chorus of chartists and YouTube creators is calling for Micron to break down level after level, all the way to 250. I've watched their videos, I've studied their charts, and I think the entire thesis is built on a fundamental flaw. If you're holding Micron, or any of the other memory titans right now, seeing headline after headline calling for a 75% collapse can be genuinely terrifying. I get it. So today, we're going to walk through exactly where that bearish thesis comes from, break down every single support level they're pointing to, and then show you the fundamental story they're leaving out entirely. Before we get into it, if you want more breakdowns like this delivered straight to you, hit that subscribe button now, because the story we're about to unpack could completely change how you think about this entire sector. Here's what's wild. The same exact setup we're about to walk through happened with Nvidia just 2 years ago, and almost nobody who bet against it based on the charts survived what came next. Keep that in mind, because by the end of this video, you'll see exactly why history is about to repeat itself, just not in the direction the bears expect. Let's start with the trade everyone's already piled into. Article after article calls the AI memory trade crowded, and looking through YouTube, the content around it is just as crowded. Dozens of creators are all pointing at the same charts, the same head and shoulders patterns, the same historical cycles from 2018 and 2021, and drawing the same conclusion. Micron is heading for a brutal fall. Here's what almost none of them will say out loud. I could be wrong. I've watched these videos closely, and the confidence is absolute. No hedge, no humility, just a flat prediction that this stock crashes to $250 within a year. I'll say it plainly. I could be wrong too. But everything in the current environment tells me that call is a fundamentally flawed thesis. Let's put this in perspective. Micron currently sits at roughly a $1.1 trillion valuation. For the bear's thesis to play out, a company sitting at the center of the entire AI memory build-out, with hyperscalers pouring in investment, would need to get cut down to something like $300 billion. Given everything happening in this market right now, that's an extraordinarily hard case to make. So let's actually walk through their chart. Draw an ascending trend line from the March 31st low near $340, right after a rough post-earnings drop, up through the recent breakout above $1,000. The bears will tell you that trend line broke in mid-July, and since then, Micron has been printing a string of lower lows. To a chartist, that pattern only means one thing: more downside is coming. Breakdown level 1 sits at $850, about a 9% drop from where the stock trades today. The argument is that after breaking down through this level in mid-July, Micron needs to retest it. Given the volatility we've already seen, a 7% drop one day, double-digit swings the next, a move to $850 next week is honestly a realistic, logical outcome. I won't pretend otherwise. Breakdown level 2 is $750, the consolidation floor from late May, right before Micron's push above $1,000. The bear's logic here is that a vertical rally like this one always leaves an unfilled gap, and a pullback to $750 would simply be a standard 20% correction testing old resistance as new support. With hyperscaler earnings landing this week, that's a genuinely plausible near-term move too. Breakdown Level 3 is $450, the multi-month supply ceiling from back in April, before blowout earnings triggered a short squeeze and a massive institutional breakout. Chart theory says that breakout base has to eventually get retested, and a drop to $450 would represent a 50% decline, which, conveniently for the bears, matches the average severity of past memory sector downturns. And then there's the final target, $340, then all the way down to $250, the valuation floor from the end of 2025, back when high-bandwidth memory was still ramping and DRAM contract prices were a fraction of where they sit today. Chartists point to the 2018 and 2021 cycles and argue that every time Micron hits peak margins, the stock falls 75% back to baseline. On paper, it looks clean and methodical. But here's the problem with that logic. Charts measure past price action. They don't measure future structural constraints. And this is exactly where I think we need to pause and ask a harder question. Why isn't pure technical analysis a crystal ball? Moving averages don't know about multi-year, legally binding supply contracts. Historical patterns assume a company's entire product mix stays frozen in time. Try valuing Amazon in 1998 using nothing but its historical retail patterns, completely ignoring where e-commerce was headed. Or imagine judging Apple in 2027 purely on how many phones it sold years earlier. That's essentially what's happening here. Analysts are treating Micron today as if it's still selling basic PC RAM like it was back in 2018, instead of the fundamentally different company it's become. Here's a real example, not a hypothetical one. Back in 2024, Nvidia traded around $92, jumped to roughly $125 to $130, and then chartists spotted a textbook head and shoulders pattern. They were just as confident then as today's Micron bears are now, insisting the stock had to collapse back down to around $80. Then the generative AI tipping point hit. Enterprise demand for advanced GPUs exploded, and that entire chart pattern became instantly obsolete. Anyone who sold based on that pattern and waited for an $80 retest missed one of the greatest technology rallies in stock market history. And I believe the chartists calling for Micron's collapse are making the exact same mistake right now, treating a company in the middle of a structural transformation as if it's still operating under the old rules of the memory business. Drop a comment below and tell me, do you think this is 2018 all over again or a completely different cycle? Because now I want to walk through the actual fundamentals driving my conviction, starting with something most people completely overlook: wafer consumption. High bandwidth memory consumes wafers at a dramatically higher rate than traditional DRAM. Take 100 wafers of standard DRAM production, and you get roughly 100 units of supply. Take those same 100 wafers and build HBM instead, and the yield differences mean you only get about 30 to 35 equivalent units. That single shift is putting enormous pressure on the broader DRAM supply picture across the entire industry. Now look at where the demand is coming from. AMD's new Helios rack, built around the MI455X accelerator, and Nvidia's NVL72 platform with the Vera Rubin GPU are both packing 72 GPUs, and both are hungry for memory in a way we've never seen before. AMD's Helios alone carries roughly 31 terabytes of HBM versus Nvidia's 20 to 21 terabytes, about 50% more HBM capacity in a single rack. The bandwidth story is just as dramatic. Helios pushes around 43 terabytes per second of scale-out bandwidth compared to roughly 28.6 terabytes per second on the Nvidia side, again about 50% higher. And remember, this is today's hardware. As AI compute keeps scaling and inference keeps taking a bigger share of total demand year after year, the memory requirements across HBM, DRAM, and SSDs are only going to keep climbing from here. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. Just last night, SK Hynix and Nvidia announced a long-term deal worth roughly $500 billion, spanning AI factory construction and next-generation memory supply. It covers a 2-gigawatt AI factory built on Nvidia's DSX platform with Vera Rubin accelerators, powered by SK Hynix's HBM4 chips. Two massive companies locking arms like this only reinforces the structural memory story. This isn't a temporary cycle, it's infrastructure being built for years. Micron has been thinking ahead too. Recognizing how much HBM eats into wafer supply relative to standard DDR5, Micron signed a 10-year, $500 million supply agreement with Global Wafers just to secure the wafers it'll need going forward. That's not the move of a company bracing for a 75% collapse. That's a company positioning itself for a multi-year shortage it sees coming. If this breakdown is actually changing how you're thinking about this sector, do me a favor and smash that like button. It genuinely helps this channel keep growing. And then there are the long-term agreements. Micron has now signed 16 or more strategic contracts covering somewhere around 20% of DRAM volume and roughly a third of NAND volume, with HBM supply already locked up through 2027. 14 of those contracts alone represent close to $100 billion in minimum guaranteed revenue over their remaining terms, backed by $22 billion in cash deposits already sitting on the books. This is a completely different market structure than the boom and bust spot pricing world of 2018 or 2021. These are legally binding take-or-pay contracts giving Micron years of revenue visibility that simply didn't exist in past cycles. When you put wafer scarcity, exploding HBM demand, new AI architectures, and locked-in long-term contracts together, you get a fundamentally different setup than anything the chartists are comparing it to. Now, could Micron still drop to $850 or even $750 next week? Absolutely. That's a real possibility. We've got a genuinely volatile week ahead, with SK Hynix and Seagate both reporting, plus hyperscaler earnings that could shift sentiment fast. If CapEx slows or HBM yields disappoint, a real correction is entirely on the table, and I want to be honest about that risk rather than pretend it doesn't exist. But there's a real difference between a short-term, high-beta pullback, which is normal and even healthy after a massive rally, and the idea that Micron is locked into repeating a 2018-style 75% collapse simply because a chart pattern looks familiar. Charts show you where a stock has been. Fundamentals show you where an industry is actually heading. And when those two disagree, that's usually where the biggest opportunities and the biggest mistakes get made. So here's where I land. I believe the fundamental thesis for Micron and the broader memory sector remains structurally intact, and I'm still holding a long-term view that points toward the $1,500 level by year's end. And just like I've said throughout this video, I could absolutely be wrong. I don't have a crystal ball, and neither does anyone predicting $250. What I do have is a read on the fundamentals that I think the chart-only crowd is choosing to ignore. If you found this breakdown valuable, subscribe to the channel so you don't miss where this story goes next. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. And if you know someone holding Micron who's been panicking over these 75% crash predictions, do them a favor and share this with them. I'm Alex Carter, and I'll see you in the next one.